Zombie apocalypse.
Hello everyone, welcome back to Eco Talks with Sneha Manerikar. In today's session, we'll start agriculture finance further part. So let us start our today's session with first question. The major subdivisions of balance sheet are A. Cash received, cash paid and cash remaining. B. Income, expenses and net profit. C. Assets, liabilities and net worth. D. Amount borrowed, amount paid off and balance outstanding. Answer is the major subdivisions of balance sheet are assets, liabilities, and net worth. Here is the sample of balance sheet. You can see here on left hand side we have assets, right hand side we have liabilities. Then on under liabilities we have owner's equity, which will be the difference between the assets and liabilities. Due to this owner's equity added to the liability side, balance sheet LHS and RHS will be equal. Then balance sheet will be calculated for the particular date. For each day, balance sheet will be getting different. So it is calculated for per day. So here you can see the title balance sheet as of. So on that day, particular day, we will calculate the balance sheet. Next question is a term which had the same meaning as owner's equity is A. Net worth, B. Net farm income, C. Total asset value, D. Total liabilities. So therefore, the owner's equity is nothing but the net worth. Now, net worth or owner's equity is the value of all non-financial and financial assets owned by an individual or institution minus the value of all its outstanding liabilities. That is nothing but net worth or owner's equity is equal to total assets minus the total liabilities. This is found from balance sheet. Next question is a project for of all expenses associated with growing an acre of a particular crop would be called A. Partial budget, B. Balanced budget, C. A whole term budget, D. An enterprise budget. Answer is for a budget related to a particular growing area and a particular crop, it would be called as an enterprise budget. So farm budgets there are four types of farm budget. First one is enterprise budget. Here an enterprise budget is an estimate of all income and expenses associated with specific enterprise and estimates of its profitability. Whenever we calculate a budget for a particular crop or livestock, then it is called as enterprise budget. Whereas partial budget it is used to calculate expected change in profit due to the proposed change in farm business. Suppose you are changing any technology or any crop or you are substituting some inputs, then what will be the expected change in profit? For that we use the partial budget. And the partial budget we have again three types. One is for enterprise substitution. If in a farm particular crop is substituted for other, for example sunflower is substituted by groundnut, then to find out the effect on the change in profit, the partial budget is used. Second one is input substitution. Now here, if you are substituting one input for another, for example, machinery for labor, then fertilizers increase or decrease in rate of fertilizer, chemicals, then instead of owning the machine, purchasing the machine, you are hiring a machine. So in such cases, to find out the change in profit, we use partial budget. Also, when you are increasing the size of farm business or particular enterprise, suppose first you are cultivating one crop, a crop A for 2 acres and you have increased it to 4 acres. To find out the change in profit, we will use here again the partial budget technique. Third type of farm budget is complete budget or whole farm budget. It is related to expected income and expenses and profit of whole farm. That is the whole farm budget. And cash flow budget is summary of cash inflows and outflows of the business. That is, cash inflow is nothing but whatever we are earning and cash outflow is whatever we are paying. So summary of that is called as cash flow budget. Next question is, which of the following would most likely warrant an increase in production by a firm? A. The firm is making money. B. Firm's marginal revenue exceeds firm's marginal cost. C. Marginal cash flow is positive. D. Firm has low fixed cost. Answer is when we say the firm is increasing its production is when firm's marginal revenue exceeds the marginal cost. Marginal revenue is nothing but the additional unit of revenue received from selling the additional unit of output. And whereas marginal cost is additional cost incurred to produce one more commodity or one more unit of output. So always revenue should be more than the cost. Is that clear? When firm in marginal revenue will be more than the marginal cost, we say that there is increase in the production of a firm. Next question is, a measure of profitability of your farm business is A, per percent return on equity, B, leverage ratio, C, debt to total asset ratio, D, current ratio. Answer is, profitability measure is percent return to equity, that is ROE. Now we have different financial ratios that can be classified as liquidity ratio. First one is liquidity ratio, under which we have current ratio and quick ratio. Then second category is profitability ratio. In that we have gross profit ratio, operating profit ratio, net profit ratio, return on capital employed. Under solvency we have debt equity ratio, interest coverage ratio. And turnover ratio we have fixed asset turnover, inventory turnover and receivable turnover ratio. And under earning ratio we have profit earning ratio and earning per share. So from exam point of view, liquidity ratio and solvency ratio are very important, and from earning ratio, profit earning ratio can be asked. So we have to remember the formula of liquidity ratio and the solvency ratio. Here are the formulas. First is solvency, also called as liquidity ratio. We have current ratio, where current assets divided by current liabilities, and quick ratio is current asset minus inventory divided by current liabilities. In leverage ratio, we have total debt ratio, total assets minus total equity upon total assets. And debt equity ratio is nothing, total debt by total equity. In inventory turnover, that is cost of goods sold upon inventory. And return on assets is net income divided by total assets. And return on equity is net income divided by sales into sales divided by assets into assets divided by equity. When the other factors get cancelled, we'll get ROE is equal to net income divided by the equity. These are the few important ratios which can be asked in the exam. Direct formula will be asked. Here is the list of all the financial ratios which will be required to calculate the financial feasibility of a business. Next question is, which of the following would tend to reduce risk for manager of a farm business? A, selecting the crop with the highest net return. B, diversification. C, selling all commodities. D, specialization in single enterprise. Answer is, to reduce the risk, farmer should go for diversification. Now, in reducing the risk, we have different methods to reduce this risk. First one is diversification. In diversification, we should go, the farmer should produce more than 2 crops, so that even if the price of one crop is low, the price of other commodity may be high and it may be compensate the reduction in the income. Then stable enterprise, that is one in which low yield variability, that is farmer will be knowing that he will get definite quantity of yield. Such crop should be selected. Then crop and livestock insurance. Insurance is the best method of reducing risk and uncertainty. Crop insurance also should be done by the farmer, and also livestock insurance. Flexibility is whatever cropping pattern or cropping plan will be prepared by the farmer, it should be flexible to adjust to coming circumstances. Next is spreading sales. Whatever output of crop should not be sold at a one time. Farmer should prefer to sell output at the several times during the year. For example, soon after harvest, he has to sell only little quantity in the market. At that time after harvest, what will happen is price will be very low in the market, and after the harvest season, 1 to 2 months after harvest, the prices tends to increase. And if farmer sells during that time, then he may get the higher income. So you should adopt the spreading sales. Next one is hedging. That is, hedging's main purpose is to reduce the risk. And last is the contract sale. Contract sale means the farmer will go sign a contract with the salesman or a retailers or any agency which will sell the agriculture products, and they'll fix the price at the time of contract, that is well before the harvesting, so they will have the fixed source of income. Next question is, which of the following is not component of income statement? A. Expenses, B. Assets, C. Returns, D. Both A and B. Answer is, which of the following was not a component of income statement? So assets is not a component of income statement. It is the component of balance sheet. The components of income statement are sales, operating expenses, income and expenses. In total, income statement will have income and expenses. Next question is, which of the following type of loan falls under the hypothecated loan? A. Autorickshaw loan, B. Promissory note, C. LIC bonds, D. Chattel loan. Answer is, example for hypothecated loan is autorickshaw loan. Hypothecated loans are carried for the movable property. Here, in case of hypothecated loans, borrower has ownership right on his movable property, and banker has the legal right to take the possession of property to sell on default, or right to sue the owner to bring property to sale for realization of the amount due. Here, borrower, whoever has taken the loan on some movable property, that time the ownership right will be with the borrower, but legal right will be with the banker. If the borrower fails to pay back the money of loan with interest, then the bank will either sell the property, or they will ask the owner to sell the property and pay back the loan amount. Here, the person who takes the loan is called as hypothecator. The person who gives the loan is called as hypothecate, that is the bank. Then in the example for this hypothecated loans is tractor loans, machinery loans. So any type of loans taken on vehicles, machineries comes under the hypothecated loans. Generally, they are the long-term loans. Next question is, which of the following is not a higher financing agency? A. IBRD, B. RBI, C. RRB, D. NABARD. Answer is not higher agents financing agencies, RRB. RRB is the taluka level or district level bank. It is not the higher financing agency. Whereas IBRD, RBI and NABARD, these are the apex national level financing agencies. RRB are the connected with farmers. Somewhat they are like grassroots levels society. So RRB cannot be the higher financing agency. Next question is, when there is break even in the business, it is advisable for financial institution A. to consider that farmer is not credit worthy, B. to recommend the farmer to depend solely on private money lenders, C. to recommend the farmers to stop the business temporarily, and D is to lend short-term loans to the farmer. So at the break-even point, financial institutes, they recommend to lend the short-term loans to the farmers. Break-even point is a point where total cost will be equal to the total revenue. And by providing short-term loans, the financial institution provides some credit so that farmer can increase their production. That will help to boost the production of the farm. So during break-even point, financial institutes are advisable to lend the short-term loans to the farmers. That's all about today's session. If you have any doubts, you can ask me in comment section. And don't forget to like, share and subscribe. Thank you.